Well, if the record rebound in the S&P 500 isn't sign enough, it looks like investors are getting a bit more optimistic about this stock market. And a brand new Schwab survey found that traders are turning a bit less bearish, even if they expect volatility along the way. Randy Frederick is VP of Trading and Derivatives at Schwab. He joins us now. Randy, good to see you. So what is behind this change in sentiment? Why are investors a little less bearish? And do you think it actually is a sign that this rally has got some legs?
Well, I think certainly that has part to do with it. I mean, the S&P 500 is up 51% from the March 23rd bottom. So certainly when you have momentum in a bear market or in a bull market, that tends to make people a little bit more optimistic. I think that's certainly it. The other thing that we find often when we do these surveys is that when there's an enormous amount of uncertainty and people just don't know where the market's heading, we often see a very large number of people say that they're neutral. And what I've kind of come to believe after looking at these surveys for many years is that neutral actually means I don't know. So when the neutral number goes down and we see more people with conviction, whether that's bullish or bearish, that's generally a positive sign. So certainly the momentum has a lot to do with it. Now we're also obviously at all-time highs now, but definitely the momentum does tend to make people a little bit more bullish.
Randy, the buzzword of the week, at least for us, is volatility. Everyone sees volatility around the corner. When you talk to clients, what type of trades are they putting on to position for that volatility, if it even happens?
Well, you're right. Volatility is something that's been expected for quite a long time. In fact, if you look at things like the volatility futures contracts, going all the way back as far as February, the October contract, which expires just a couple of weeks before the election, has actually shown a pretty sizable spike for a long time. And that spike has been there the entire year, even through some of the tremendous volatility we saw in March and April and May. So that obviously is related to the election. Now, you might think, well, why wouldn't it be the contract right after the election? The reason for that is because that's typically how volatility works, is the highest level of anxiety or uncertainty typically occurs just before the event. We know the date of the event. We know what election day is. We also know that there's two possible outcomes. We just don't know what that outcome will be. And so there's an expectation that volatility will increase as we get closer to the election. That does make some sense because volatility obviously spiked back in March. It has been slowly coming down, but even at its current levels, it remains several points above the long-term average and even the long-term mode, which is more of a normal level. So are people anticipating, or are they doing strategies related to that? We do see that to some extent. There's some benefit, but one of the challenges is that when everything that has an expiration out just before the election, it's all priced more expensive right now. So if there's any way you can take advantage of that, one of the ways is to put on a multi-leg strategy where you're selling a contract closer to the expiration and buying one near term, because then you're basically selling one that's relatively expensive, buying one that's relatively cheap. That kind of activity we see. But people, I think, who are buying positions that are high priced because they expire around the election right now may actually end up overpaying just a little bit.
Randy, I was a little surprised to see in your survey that most traders changed their investing strategy since the start of the pandemic. 46% of them said they traded more. Can you tell us what kinds of moves they made?
Well, this is not uncommon. In fact, anytime you see a market that pulls back, and obviously we just came out of the longest bull market in history, and throughout that bull market, certainly throughout the last 2 or 3 years, every time the market had a dip, people came in and bought. And we saw that happen again this time. Obviously, this was a much more severe downturn. It went into a full-blown bear market. But once we started to come out of that, things were priced more favorably than they had been in quite a long time. The other thing is that people who tend to trade a little bit more actively or who are a little bit more engaged in the market will tend to trade more when volatility happens. And obviously, we had some tremendous volatility. And there's several reasons for that. One, when the market goes into a downturn, which is what typically causes a spike in volatility, generally you have some people who are trying to sell positions and capture those gains before they go away. Secondly, you will have people who will put on hedges to try to protect the downside in case there's a further downturn. And then third, you'll have bargain hunters. All three of those people will drive volumes. And you can go back and correlate market pullbacks with volume levels, and the volumes always go up in the pullbacks, and they go down when the market goes into a sideways movement or a very slow upward trend. So that's actually not at all uncommon.
Randy, how might the Federal Reserve meeting in mid-September, just before the election, how might that impact volatility?
Well, we generally don't see a lot of change or a lot of impact in volatility from the Fed unless there's an expectation of a change in rates. Now, I know Jay Powell said that they're not even thinking about raising rates. So there's no question we're going to be at zero interest rates at the end of this year. In fact, we're probably going to be there for several years. So I don't really think there's going to be an enormous impact. You sometimes will get a little bit of a ripple when minutes are released, as we saw this week, but it's generally very small and fairly short-lived, sometimes maybe just an hour or two in the day. So I don't think that's the big issue. I think the bigger issue is the election, and not just the presidential election, but also what happens with the House and the Senate. I think most forecasters would tell you that the most volatile potential is if we have a clean sweep where the Republicans control all three or the Democrats control all three, because that allows for very drastic change, and the market tends to not like change so much. So if the president changes, but the House and Senate remain split, that's generally a fairly good scenario. So, but that's primarily what's driving the volatility. I don't think the Fed has a whole lot to do with it right now. They're pretty much on hold. One thing that is driving it a little bit here in the very near term, of course, is the next rescue package. We have Democrats and Republicans who haven't come together to come up with another package. Some of the benefits are starting to run out, and that will have an impact on consumer spending, which we saw a spike in that when the first rescue package came out. But when the second one doesn't occur, we're going to see a downturn probably there.
All right, Randy Frederick, VP of Trading and Derivatives at Charles Schwab. Thanks for being with us this morning.
My pleasure.